Welcome to the Friday edition of Tech Stocks Daily. Buckle up, tech aficionados, because today we've got a whirlwind tale of market movers and shaker-uppers. We're diving headfirst into Braze's revenue excitement, exploring how its fiscal fireworks outshone Wall Street expectations. Then, we'll sail into the high seas of Roku, where analysts' optimism meets big investors' contrasting strategies. Lastly, AT&T takes center stage with discount changes and a roller coaster stock spree that might just have you on the edge of your investment chair. Ready for a journey through today's tech stock landscape? Let's go. All right, folks, let's dive into today's tech-buzzing beehive, starring Braze, the customer engagement platform that's making waves. So why is Braze lighting up your newsfeed? Well, grab your calculators, because it's all about those sizzling fourth quarter results from fiscal 2025 that had everyone's eyes popping. Braze, trading under the ticker BRZE, just outpaced the analysts' expectations with style and flair. Their quarter saw revenue hitting $160.4 million, comfortably above the $155.72 million forecasted by Wall Street analysts. We're talking about nearly a 23% jump from the same quarter last year, folks. Talk about setting benchmarks. And if you think that's something, strap in for their earnings performance. Braze reported non-GAAP earnings per share at a solid 12 cents, a dramatic flip from a 4-cent loss in the previous year and well ahead of predictions pegged at 5 cents. This makes it their third consecutive quarter of non-GAAP net income profitability. They're not just riding the waves, they're surfing them all the way into fiscal 2026. Fueling this triumphant execution was an upswing in new customers, renewed agreements, and upsells. Talk about customer relationship goals. The numero of large customers, each bringing home an annual recurring revenue of at least $500,000, shot up from 22 to a hearty 247 over the year. Nice banquet table seating there, Braze. CEO Bill Magnuson painted quite the optimistic picture in their earnings release. Fiscal 2025 was a milestone, he said, thanks to robust customer augmentation and persistent advancement in products, particularly via aggressive investments in AI and machine learning technologies. Curious to know how the free cash flow fared? It didn't just coast through. It catapulted from a $3.5 million loss to a $15.2 million surplus. Grab your shades because those numbers are beaming bright. Looking forward, the company's leadership is brimming with confidence. They're projecting fiscal 2026's revenue to hit between $686 million and $691 million, marking a 16% rise at the midpoint. Not only is JP Morgan's Pinjalim Bora unfurling a proverbial carpet for Braze with an overweight rating, but analysts are also jazzing up their forecasts following these stellar results. With Braze leaping ahead on its retail focus and freshly signing an agreement to acquire OfferFit for agentic AI-based A/B testing, it's clear they're not just playing the field, they're strategically planting their flag across it. So if you're one of those investors with an eye for momentum, today's numbers suggest that Braze might just be the unicorn galloping your way through NASDAQ pastures. Stay tuned, because if the vibes from management's optimistic guidance hold, this company could be riding a wave that's building more ripples than a pebble in a pond. Hey tech aficionados, welcome to today's scoop on the latest drama and excitement in the world of tech, where big whale investors and sharp-witted analysts are setting the stage for Roku. Let's dive into what caught the eyes of investors today. First up, brace yourselves. When whales are making moves, it's time to pay attention. And yes, I mean the mega investors, not the ocean giants. There's been a notable stir in the market as some deep-pocketed investors have shown a bearish stance on our beloved Roku. If you've got your ledger ready, here's the breakdown. A whopping 75% of these heavyweight investors are betting against Roku, with puts totaling $149,000. Meanwhile, a slim 25% are backing Roku with calls worth $179,775. Clearly, it's a bit of a mixed bag on the high seas of stock predictions. One curious pattern emerging here is that these big shots are eyeing price zones between $60 and $150 over the past 3 months, indicating where the smart money is swirling like a whirlpool around the potential price movement trends. But what's driving this weather vane of optimism and caution? Enter stage right, the analyst brigade, who, armed with price targets and earnest opinions, have been busy adding their 2 cents. Or should I say billion cents? JP Morgan's analyst Brent Navon remains a fan with a steadfast buy rating, setting eyes on the $100 mark. Navon believes in the Roku story, praising its hardware and software that have led to a mass adoption and a massive leap into the streaming zeitgeist of the past decade. Is Roku ready for its next showstopper phase? Navon argues Roku 2.0 is on the horizon, a bold venture into monetizing its significant user base of over 90 million accounts who've streamed over 125 billion hours in 2024. The company is already a big fish in a sea of shifting media strategies, and as Navon sees it, the company's innovations in advertising, international streaming penetration, and sheer scale make it a classic buy more popcorn moment. Plus, predictions for stunning revenue, profitability growth, and industry trend alignments make this a potential powerhouse in media economics. Then, there's a little strategic love from Needham and Citizens Capital Markets. They tweaked their ratings with optimistic price targets of 120 and 150s, respectively. It seems like each jump in Roku's story demands popcorn and a front row seat. So, as analysts adjust their sights and smart money bulls and bears wrestle in the options arena, Roku stays firmly planted at the center of tech intrigue today. From household streaming dino to financial market player, Roku's saga continues. Keep your eyes peeled and watch the headlines. There's plenty more where this came streaming from. All right, tech enthusiasts, grab your popcorn because we've got some sizzling news about AT&T that's been buzzing through the wires today. Yes, the telecommunications giant has been making waves with a few shakeups that both investors and subscribers need to know about. First up, let's talk discounts. AT&T announced a tweak to their autopay and paperless billing discounts. Starting next April, certain customers will see a cut in their discount from $10 down to $5 when using eligible debit cards. And if you're using a non-AT&T Points Plus credit card, you're saying goodbye to that discount altogether. But hey, before we all start freaking out, those of you using a bank account for payments are safe. You're sticking with the $10 discount. It seems like AT&T is riding the same wave as its peers, T-Mobile and Verizon. It's like when all your friends start wearing the same outfit, and you feel like you have to join too, right? Is this something you'd want to see more telecoms adopt, or is it just another move away from customer savings? Dive right into the comments and let us know what you think. Okay, investors, let's chat dollars and cents. Yep, that was definitely supposed to be cents, but isn't it funnier this way? AT&T's stock saw a tremendous rally over the past year, climbing nearly 60%. What's behind this surge, you ask? Well, AT&T's strategic rollout from past burdens, like heavy debts and failed acquisitions, has brought it back into telecommunications limelight with renewed focus. It's like that moment in makeover movies when the underdog comes back winning classic, avoid the debt pitfalls. Plus, they've got their eyes set on meeting their 2025 financial targets. Question time. Are you planning to make a move now that the buzz is hot, or are you biding your time for calmer waters? Now, for all you dividend divas out there, the stock still offers a juicy 4.1% yield, a big reason many investors still have this sleepy giant in their stock folders. That said, AT&T might not be your firecracker for massive growth, but for steady treaders looking for well-supported earnings, it could be a gentle destination. However, not everything's a rose garden. With cell phone saturation in the US, AT&T might not be leading the pack on exponential growth anytime soon. But give this gentle giant some credit. It reported decent guidance ahead of its Q1 results, and with its reliable dividend payouts. Well, let's just say it knows a thing or two about its audience. All right, enough from me. It's your turn, Team Tech. What do you make of AT&T's discount changes and stock shuffle? Feeling bullish, bearish, maybe even a tech raincoat fashionable enough to envy? Hit the comments and spill your thoughts. All right, tech enthusiasts, let's switch gears and focus on one stock today. I'm picking Roku from our tech buffet because who doesn't love a good streaming service drama? So, what's the verdict? To buy, to hold, or to sell? Based on today's buzz and financial tea leaves, I'd lean towards, drumroll please, holding Roku. Here's why. Roku's got some intriguing moves going on. Despite the cautious bearish stance among some mega investors, tech analyst Brent Navin from JP Morgan is passionately backing Roku, nudging it up with a buy rating and a price target slated at $100. This optimism rests on Roku's solid expansion ventures, from monetizing their vast 90 million user base to potentially innovating around advertising. It's almost like a streaming service turning into the host with the most varieties of popcorn flavors. Everyone wants a taste. Plus, while the uber-big investors are showing mixed signals, interesting patterns suggest a price zone uptrend between $60 and $150 over recent months. What intrigues me is Roku 2.0's potential, possibly embodying streaming's future while pushing the envelope in international markets. That's like a superhero preparing for the sequel that fans can't wait to binge watch. However, because there's also looming ambiguity with those bearish investor signals and the volatile nature of stock prices, holding rather than taking a leap to buy or a sharp decision to sell feels like a savvy middle grouse stance. It's like gauging whether to renew that long-standing series subscription, never too rushed, taking into account everything new that's coming, including changing tastes. But remember, folks, don't just take my word for it. Always do your own research. Consult with a financial advisor and keep the big picture in view, especially when you're looking at your long-term investments or fleet-footing trades. May your portfolio be prolific and your knowledge ever-growing. Wow, what a whirlwind of a day, right? We've seen Braze shining with its stellar fourth quarter performance, Roku surfing through some investor whirlpools with analysts betting big on its future, and AT&T popping up with strategic changes and breezy stocks dancing in the market current. Who says tech isn't spicy? Remember, folks, if today's tech tales tickled your fancy, give that like button a nudge, subscribe for your daily dose of tech delight, and share the buzz with fellow enthusiasts. I'll catch you on Monday for even more tech adventures. Until then, have a fantastic weekend, techies.